Welcome to today's loan update. My name is Tish Norton, mortgage broker and director of Black Sheep Finance. The reason for this update is because in the past few weeks we've had unprecedented lending changes. This is a very important update because it is happening right now and will affect everyone in some form or another. Whilst for the most part the focus will be on investor lending, these changes are actually going to bring about benefits for homeowners. So hang in there because this information could save you thousands. I need to make sure that you are aware of your situation and what your lender may or may not be doing to you. Many questions will be raised during this video. I've already had a flood of responses from my initial email 2 days ago, so make sure you write down all of your questions and I will get back to each and every one of you as soon as I can. So before we begin, I have to make you aware of this disclaimer, and that is that the information provided in this video is of a general nature only and are not to be considered financial advice. Black Sheep Finance are not permitted by law to offer you financial advice, and we will not do under any circumstances. Black Sheep Finance supplies you with this information on the understanding that you will not enter into any purchase relying purely on these figures or information produced herewith. On supplying this information to you, we suggest that you contact your financial planner or accountant to determine the accuracy and suitability of this information. You may also consult with your accountant in regards to depreciation and tax rates, and you should consult with a financial services advisor regarding the viability of any investments. If you do not have any advisors, please contact us and we will be able to find someone who can assist you. So let's get straight into it. What on earth is going on that has caused one of the biggest shifts in lending? To put it simply, APRA made an announcement and the banks have had a bit of a knee-jerk response. So I guess first of all, who or what is APRA? The Australian Prudential Regulation Authority, otherwise known as APRA, is the prudential regulator of the Australian financial services industry. In other words, they're the guys who regulate the behaviour of banks, credit unions, builder societies, and a whole bunch of other people in the financial services industry. Whilst they aim to enforce standards to keep the financial industry stable and competitive, I'm personally not in agreement with their recent attempt to protect you, the consumer. Mostly because these changes are an extreme attempt to control a singular segment of the market by punishing everyone. The catalyst for these changes has been the substantial growth in property prices, but has only occurred in Sydney and a part of Melbourne. However, the blanket approach is going to substantially affect all markets, and that, in my opinion, is not working in the best interests of you, the consumer. So, what are the changes and how will it affect you? The ruling that APRA made is that banks and lenders should restrict their investor lending growth to no more than 10%. Growth, of course, implying that if you wrote $100 million of loans last year, you cannot exceed 110 million loans this year. From this ruling, the banks and lending institutions were basically able to interpret it any way they saw fit. As a result of that, what we have seen in the past few weeks are the following changes. The amount of deposit required has increased, serviceability rates have increased, interest rates have increased. Let's discuss each in detail. Amount of deposit required. This is in relation to restricting how much you can borrow against the value of an investment property. Before you could borrow 90%, sometimes 95% of the value, which means you could use less cash to buy the property. As of now, the following banks have reduced all new investor lending to 80%, meaning if you want to get a loan with these banks, you will need 20% plus costs if you choose to get a loan through Westpac, Bank SA, Bankwest, and ING. Despite these banks tightening LVRs, there still are lenders willing to lend 95% on investment, well, for now at least. Our next significant lending change. Serviceability rates have increased. When deciding to approve your loan, a bank will assess your income and expenses using an array of calculations. The figure that is important to determine how much you can borrow is the assessment rate. As interest rates are at an all-time low, it is no longer viable to assess the ability to repay a debt at only 2% higher than the current rate, which used to be the norm. For example, if you can get a rate in today's market at 4.2%, then you would get it assessed at 6.2%. So in the event that rates go up, you can still make the repayments. Some banks have not only increased this, but also how this applies to your existing debts. For example, bankers say have increased their assessment rate to 7.79%, plus your external debts will be based on principal and interest repayments, not actual repayments. So let's say your loan was $300,000 and you had a rate of 4.5%. The actual interest repayment for this would only be $1,125 per month. That's what you have to pay. This is the figure you care about because that's what you pay, and you have to make sure that the rent of your investment property covers the majority of this. However, the figure the bank will want you to be able to cover from an assessment perspective is $2,158. Almost double. When banks insist that you must have enough income after your personal living expenses to pay your existing debts at the assessment rate with principal and interest repayments, it will cripple your ability to borrow. Other policy changes. CBA and ME Bank now only take 80% of overtime and bonuses instead of 100%. So if you earn a base wage and the majority of your income is through overtime, these banks will now only take 80% of that, regardless of how much you have earned over time and how consistent it is. They will only take 80%. CBA are restricting a maximum gross yield of investment income to 6%, which basically means if you buy a cash flow positive property that has excellent rental returns, say for example 8% yield, it won't matter because CBA will only use 6%, which they will then discount down to 80%. Westpac have decided that no negative gearing benefits will be allowed in servicing. There are many more policy changes across the lenders, too many to list here though. So it is really important, if you are in the market right now to buy an investment property, to make sure you get an updated assessment on how much you can borrow and which bank will give you the money you need. The other huge change from banks is that interest rates have increased. Most lenders have already announced and passed on or will soon be passing on an increase in interest rates to all investment lending. What's most ridiculous about this is that the restriction from APRA is only to restrict future investment growth, meaning new business. However, the result is that in most cases, the interest rate increases are being applied to all loans, meaning both existing and new. Furthermore, the cost of capital has not gone up, so these increases are actually going straight to the bank's profit. So here's a quick snapshot of some of the lenders' rate increases. Adelaide Bank, up 0.2%. This is actually the smallest increase of all the lenders that are moving on their rates. They are applying this to all existing and new debts. ANZ are going up 0.27% on all existing and new debts. AMP are going up 0.47%. This is the highest of all the lenders. However, it's only going to apply for existing investment loans, and that's because they are no longer accepting any new investment lending. Huge news. Bank of Say and St. George, Bank of Melbourne, all the same family, going up 0.25%, and that's for all new and existing. Bank West, one of the only banks who aren't actually going to be penalising their existing customers. Good news there. If you currently have an investment loan with Bank West, your existing rate will not go up on your investment debt. However, new will apply for an increase. They're not having a blanket approach like the other banks, so it will vary depending on which product you choose, which obviously makes things more complex. CBA are going up 0.27% on all new and existing. Choiceland up 0.29%, all new and existing. ING, the other lender who also isn't going to be penalising their existing customers, so good news for you. If you have an investment loan with ING, your rate will not be increasing. However, there will be no discounting on new lending, the base rates will apply. Macquarie are going up 0.27% on all new and existing. NAB up 0.29%, again all new and existing. Suncorp up 0.27%, new and existing. Westpac also up 0.27%, new and existing. Whomever you bank with, you'll either have received or soon will receive notification about your loan changes if you have an investment loan. These changes will either be effective immediately or in the coming weeks. Whilst these changes hold some negativity, you as an investor have a choice. You can stick your head in the sand, whinge about the changes and do nothing, or you can get creative. Don't let the banks win, and let's take advantage of the opportunities that present themselves. Let's get some perspective first. A 0.27% increase on a $350,000 interest-only loan will add $945 per annum to your loan expenses, which is a little under $19 per week. However, it also increases your tax deductions. Remember that you can claim the interest on your investment loan, therefore it isn't a true direct cost. If you don't want to put up with the bad behaviour of your bank, then you may want to consider looking at what other options are available to you, as there are still some lenders that are offering good rates to investors on both variable and fixed products. And here's the kicker. It's not all doom and gloom, there is actually some good news. Whilst banks are increasing interest rates for investment, they are also decreasing interest rates for owner-occupied lending. Of course, banks being banks, they are not offering this to existing customers, only new business. So to get a better interest rate on both your investment and owner-occupied lending, you may need to consider refinancing. But please note that refinancing is not suitable for everyone, and there is a cost to do this. Everyone's situation is different, and as professional mortgage brokers, our primary concern is your financial well-being. We assess your personal financial situation and goals and ensure that any loan we offer to you suits you, your financial goals, and your expenses. If you would like to know how these changes will personally affect you, then please email me direct at tish@blacksheepfinance.com.au. This video is going to create a massive response, so help me out by letting me know your current loan amount, your bank and interest rate in that email, and I promise to get back to everyone within 2 business days. Even if you aren't a current client, please email me and I'll still be more than happy to help. I hope you have found this update useful and I welcome your feedback and questions. Thank you, and I look forward to hearing from you soon.